You can work the interest cost and the debt tax shield into the model in the same way. You start with a levered company and make a hypothetical assumption about what would have happened if there had been no debt. In the hypothetical scenario, interest costs could have either been distributed to shareholders during the holding period or accumulated on the company's balance sheet and distributed when the company is eventually sold. This makes interest cost a negative value driver. We'll start by assuming that we actually know the total amounts of interest paid. Here, the capital INT represents the total interest payments, and the large sigma term tells us that it's the cumulative sum of all the interest payments over the holding period. Now, we must also account for the fact that interest reduces a company's tax burden, so we create a positive value driver to represent the debt tax shield, which is equal to the product of the interest cost and the corporate tax rate. And then, to make sure that everything balances, the hypothetical unlevered cash flow generation term must be the actual cash flow generation plus the interest payments minus the debt tax shield. We can simplify these formulas by combining the interest cost and the debt tax shield together into a single value driver, and you can do similar rearrangements with the unlevered cash flow generation term. And this gives us two value drivers that always add up to the traditional cash flow generation, which is simply minus the change in net debt. Alright, that's fine as long as you know the cumulative interest payments, but LPs typically don't have access to this, and even deal teams might have a hard time figuring out the number. A reasonable shortcut would be to take the product of the weighted average cost of debt and the average total debt over the holding period as an estimate of the average annual interest cost, and then multiply that by the holding period in years. This should get you fairly close, and you can even swap out the average total debt number with an average net debt if that's what you have. Chances are that in a levered deal, there's not much capital just sitting on the company's balance sheet, at least not enough that would materially distort these numbers. Another thing you could do is try to plug in LIBOR plus 300 basis points for the interest rate. Quite often you'll find this substitution in the academic literature. It's used where researchers don't have access to the actual interest rates or actual capital structure data, because they're typically dealing with hundreds or thousands of companies in their data sets and they're trying to deduce broader industry dynamics. Anyway, we're going to find that most of the time we're probably using some kind of rough estimate for interest. Fortunately, those estimates being wrong will not ruin the value bridge and make the value drivers add up to the wrong number. The unlevered cash flow generation, interest payments, and debt tax shield will always add up to regular value creation, even if the interest cost is wrong. Here's what the value bridge will look like. The after-tax interest cost will always be a negative value driver, and it will always give us a larger or less negative unlevered cash flow generation value. If you want to see how this works, as always, you can find an Excel template for this model on the website.